Hey, it's Amy Lewis from the KFBK Morning News, along with Brandon Hafley from Catalyst Mortgage for the Catalyst Report. Last time we talked about shedding more light on mortgage and refinancing processes, right? And how you can make smart decisions. We've talked recently about the difference between banks, independent mortgage lenders, and brokers specifically. So we're going to kind of break this down a little bit more. So first of all, define what the three are.
Well, so you have your bank, traditional, place you go to for your deposits, independent mortgage lender, where usually all they do is mortgages. And then a broker, same thing, all they do is just, mortgage loans, but they might have different product, variations from a traditional investor. And a broker, to be clear, brokers a loan to a bank or brokers a loan to an independent lender.
So are there pros and cons with each? Is one better than the other?
Well, it goes into, so last time we talked about the differences and we kind of broke down, okay, A, B, and C. And when you're doing a mortgage, you kind of want to shop with all three. You go back 5, 6, 7 years ago, people used to just go to the bank. Hey, I have my checking out here. I want to talk to a bank. Now you're starting to see consumers shift away from always going through their banks to going to an independent mortgage lender or a broker. And it's important to understand the product variations between the three. Like I said last time, jumbo loans for banks, they have the best pricing hands down. Mm-hmm. And so really, if you are looking above the 474, which is the cap in Sacramento, the Sacramento region, 474,000. If you're looking above that for a loan amount, you're now in a jumbo category. So who has the best pricing? Traditionally, banks do. They give the best rate, for that product. Well, let's say we have, you're purchasing VA or an FHA and you have lower credit, 580, 570, 560 credit score. A bank isn't going to give you a loan. They're going to say, sorry, we can't do it. An independent mortgage lender can do it. Their guidelines are going to be more relaxed. And the same thing with a broker. Their guidelines are going to be as relaxed as that lender, but they're going to go ahead and shop the loan to different lenders as well to see who has the best deal. It's important to know that with a mortgage and with any of these programs, you always want to shop at the same day and time. Mm-hmm. Bank, broker, lender, whoever it is. Because then you're really actually going to compare apples to apples by also noticing the differences.
Let's set aside the credit report. Let's set aside what our credit rating is and look at incomes. How much is that going to factor into, like you said, the mortgage to the independent mortgage lender, the broker, or the banks?
And you're talking about what somebody makes.
Yeah.
Okay, so it's a great question because it goes into Fannie Mae and Freddie Mac. And we'll just touch on this for a second, but Fannie Mae and Freddie Mac allow for basic underwriting guidelines. Banks and also lenders can do overlays. So it's like, okay, here are the rules, but this level isn't enough. I'm going to go ahead and I want it here. So they're going to say, we want your debt to income ratio to be 43%, whereas you might be able to go to 45 or 50 on an FHA. So
Stop. Income to debt ratio for the consumer, define that.
Thank you. Debt to income ratio, what your overall debts are in percentage to what you actually make, your gross income. Now, we should do a topic on this one because this is a really good discussion, but it's important that that a bank might say to you, your debt to income ratio is too high. Your percentage of income versus your debt, it's too high. Can't do the loan. Whereas if you go to that independent mortgage lender, they might be able to do it. And when I loop back to Fannie Mae and Freddie Mac, they set the guidelines. Independent mortgage lenders and brokers usually follow those guidelines to a T, no overlays. Whereas a bank will say, you're going to allow it as a government agency. We don't want it. We don't want that loan on our books. Maybe it's too risky for their portfolio or what. So that's why I always say, all three, always shop all three.
Speaking of three most important things I need to remember about this conversation.
I would tell you that people need to shop. When you shop, make sure you shop on the same day. And more importantly, also understand the differences between the three, the banks, the independent mortgage lenders, and the brokers. Because once you have that, you're giving yourself the power and you're making sure that you're getting the best deal.
And be confident in what you know.
Be very confident. Educate yourself.
I got the third one.
That's the fourth.
I'm telling you, there's a lot of things that you need to know, which is why we're doing this. And I'm so happy to do it. Remember, you do have choices when it comes to your mortgage or your refinance, right?
Absolutely.
Absolutely. So the more you know, means the more you benefit from your knowledge. You can find out more at the Catalyst Report. You can also go online right now and learn more at catalystmortgage.com.